Lots written about you. You just heard all this stuff about Europe. In the mortgage world, do you care about Europe?
Well, sure, because in the mortgage world, you're in the fixed income world. And so you're going to have a price movement that moves along with fixed income, and you're trying to perform, though we're using mortgages, better than other bond sectors. So, and it's tough now with treasuries at the long end on fire. And meanwhile, junk bonds have been falling pretty much every day this week by a fair amount. So there's a lot going on. We have to think about that.
It's all interconnected.
Well, sure, because the mortgage market, more than half of it is actually more than three-quarters of it is Ginnie Mae and Fannie Mae and Freddie Mac. So that works like government debt, although it has the refinancing component that makes it more complicated. And then you've got the non-guaranteed mortgage market, which is over $1 trillion, and that is going to move around with credit. And people are not that focused right now on the default risk of mortgages like they probably should be when you look at the high-yield bond market that's getting kind of nervous.
We got you for the entire hour, and I want to pause within this nutness, if you will, and this crisis. Folks, I grew up with the Gundlachs. In Western New York, the land of engineering, there's like the Eastmans, the Bausches, the Lams, the sunglasses. And when I was a kid, there was the Gundlachs, and they did all sorts of stuff in Buffalo and Rochester. Look at this. When I hear Gundlach, look at that viewfinder camera. That is a work of art. We think that out on the internet, Google Images. That's part of the Gundlach heritage. You are known as a math whiz. It was almost accepted that if you were a Gundlach, you had to be good in math, whether it was you over in Buffalo or me over in Rochester. The Gundlachs had to know math. What was it like growing up with that heritage of engineering and mathematics?
Well, I just gravitated towards mathematics because I was interested in it and I was kind of good at it. And one of my best friends was a really good math whiz, too. He's now the chairman of the Columbia University Electrical Engineering Department.
Well, that'll do it.
Yeah, and so we used to hang around, and I just started, I liked math, and so suddenly I turned into a math guy. My father's a chemist. My uncle invented the Xerox copier. He was a physicist.
He's a guy I knew.
My grandfather was
Greg and Eric were your...
Greg and Eric and Kurt.
Cousins,
yeah, my cousins, and they were all, they're in Rochester, and the rest of our family was mostly in the outskirts of Buffalo.
Right. When you look at this, and when you look at the mathiness now, and then we see the J.P. Morgan flap of this week, are we too math-centric when we manage bonds like you or like PIMCO or others? Are we relying too much on math today in our models?
Well, I don't believe in models. I'm a math guy, but what really means, the way I think about things, is space relations. It's more of an abstract way of thinking of math rather than a bunch of Greek letters and formulas, which is more applied math. And I think one of the reasons that we've been able to succeed at DoubleLine is we think about fitting portfolio pieces together, kind of like a space relations problem. I mean, I used to, when we build portfolios, I have a funny phrase for it. I call it loading the dishwasher. If you have a dinner party, you've got tons and tons of dishes. How do you make them all fit in the dishwasher?
Right.
That's kind of the way we think of portfolios. Every asset class, every type of bond has a different risk, different reward, works differently with the economy, and so they sort of have a shape to them. And the idea is to fit them all together so that you don't have any gaps. And that way perform.
I like that. Let's look at what you're pushing against here, this constraint. This is the endless moderation of the 5-year full faith and credit yield. When Jeff Gundlach wakes up in the morning, what do you do with the financial repression of the day?
Well, the first thing you do is you realize that there's absolutely no reason to own any investment-grade bonds that are inside of 3 years for sure, and maybe these days even 5 years is getting to that category because it just basically has no yield. A 2-year treasury yielding 20 basis points, the way I look at it, it's the same as cash. At DoubleLine, we don't measure investment success in increments of 20 basis points. So cash and 2-year bonds are basically the same thing. What's a 2-year bond that essentially yields the same as cash at zero? It's a promise to get a suitcase full of cash in 2 years. I'd rather have the suitcase full of cash today than someone promising to get to me in 2 years. So we don't like the short end of the curve at all. Plus, Ben Bernanke has pledged to keep short rates at zero. So it's not like you're going to be rolling anything over at higher yields anytime soon. And of course, it's just nonsensical to think that short-term interest rates are going up in the United States, even if you're a little bit worried about inflation, which the markets aren't telling that story today, but if you're worried about that, I mean, the Fed is not going to raise interest rates voluntarily to suppress GDP to fight inflation. The Fed probably wants inflation to go up. That's the way out of this debt problem, is to have some nominal GDP. Why in the world would you do a 1980s Greenspan or Volcker type of thing, and raise interest rates to suppress nominal GDP, which is what you're doing when you're suppressing inflation. So you don't buy short bonds today.
Let's go back. Jeff Gundlach with us for the entire hour. Most of Christine Harper will join us later on Question of the Week on the debt, the deficit, the fiscal cliff. Send in your questions midday at Bloomberg.net. We will do that tomorrow. Where are we? Negative 97. The tape is amazing. We could do a full data check. Look at the 10-year yield, a 171. It's on the edge of Ira, Jersey. We'll be back.
It's broken down.
It's broken down. Jeff Gundlach says it's broken down. It's broken down. He has a gold medal. He has a gold medal in bond investing. Jeffrey Gundlach with us for the hour. This is my first great story at Bloomberg. Matt Winkler said to me, "Well, just do something," when I walked in the door. And the book people said, "Well, what book should we redo?" And so this is a book that I had redone at Bloomberg Press. Inside the yield book, Homer Leibowitz, and this is a book that Mr. Gundlach knows. You actually walked into Trust Company of the West knowing nothing about bonds?
No, I learned about bonds the week before I walked into Trust Company of the West.
Deep experience. What'd you learn from Homer and Leibowitz's classic?
Well, it basically breaks into two parts. And the first part is a bunch of numbers and tables, but there's a lot of, like an essay too, and it talks about reinvestment and about how bond returns are significantly, the interest rate reinvestment component is significant in driving the returns. And then the second part of the book was a whole bunch of formulas about how bonds work and all this stuff. And I had been at math graduate school at Yale, and so I went and I derived all the formulas myself to try to understand what was going on.
Sure.
I was so naive. I figure everybody did that stuff, that everyone would derive the math formulas. But it helped a lot to understand. What's interesting about that book today, though, is the basic premise of the book doesn't really hold anymore, because the reinvestment component of bonds only really adds a lot or drives the return significantly when there's a coupon of significance. See, in those days, interest rates were at 8, 9, 10%. Right. So you were getting 10% back, and what you were then able to invest it at made a big difference while your flow was coming. These days, the coupon's non-existent, so actually price action is almost everything right now.
Price action is everything. Are you managing for total return? You're certainly not managing for coupon.
We're managing for total return. Now, what we're doing, though, is investing primarily in our total return fund and mortgage-backed securities, where there is a coupon, although it's not what we'd like to see, based on old school thinking, but we can generate about a 6% anyway.
A guy named Bill Gross has a Monroe Trader on his desk. This is I got a picture of it that I have out on my site, and it's convexity and duration and all that. What is the day-to-day management distinction of double line versus PIMCO, or for that matter, any other bond house?
Well, we use a scenario analysis approach that we developed a long time ago. A lot of people like to use predictive models. They like to take the variables that drive, say, prepayments on mortgages, which is a big thing in the mortgage market, and they like to think they can predict what they're going to be, and they put a lot of brain power into trying to guess what they're going to be. We take a different approach. We kind of believe in what Socrates said, and that is, it's not that you try to know everything.
He was on the show last week. Continue.
He's getting up there, huh?
Yeah.
But his thing, the thing is, he said that it's not that you try to know everything, it's to respect the fact there's certain things that you cannot know.
Right.
You can't figure it out. So don't delude yourself that you can know everything. So what we do is we say, look, interest rates are either going to go up or down. That sounds non-controversial ultimately. So if interest rates go down, it means that refinancing activity will go up. We don't know how much, so we explore it, and we explore kind of the parameters that are plausible. And the same for rising interest rates. And in that way, we risk protect, because we look at discretely what might happen for discrete forward-looking scenarios, rather than guessing some model what's going to be. We're
going to rip up the script here, folks. This is so important. If you then guess discretely, when you observe the derivative blow up at JP Morgan, they got slammed by an exogenous shock, which is this massive liquidity, full faith and credit, price up, yield down. When you observe that, did they just guess wrong, or did they just completely screw up the math?
Well, I'm not really sure what goes on inside of JP Morgan. I mean, so it's hard to know. But typically, when there's blow-ups, it's because models assume various correlations.
Correct.
They assume that if X happens, then Y will happen, and they they delude themselves. They think that you can know that, say, if Spanish yields drop by 100 basis points, then for certainty something's going to happen, say, to the U.S. junk bond market. And you can get loose correlations that are somewhat convincing, but you have to understand that you can't know exactly what's going to happen. Whenever you have these hedge funds that blow up and everything based on correlation trading, it's because they are over-believing in the precision of models to forecast the future.
Did they get slammed by the exogenous shock of the ECB flooding the system?
Again, I don't really know what the inner workings are there, but it seems like something like that likely happened. Yes.
Let's make some money right here. This is a great quote. I picked it up in the Wall Street Journal, I believe it was. This is Mr. Gundlach. If I were one of those crazy hedge fund guys with the slick haircuts and the fancy shoes and racy striped shirts, the trade I'd put on is 10 times leverage natural gas versus 10 times short Facebook. I mean Apple. Okay, then bring up the chart if you would right now. How's this trade doing? Don't tell me you didn't do
first
this.
of all, I didn't say that. I said 100 times leverage, not 10 times leverage.
Bring up the chart right now, chart 3. This, we welcome this, folks. It's the Gundlach, because Gundlach's on and he's got these fancy math degrees. It's 6 standard deviations out. That's Apple against natural gas. It is off the regression, isn't it?
Yeah, well, the idea there was, and I said this a little over 3 weeks ago, Apple was at 610 at the time, and natural gas was at $2.10. And today Apple is down at 560 or so, and,
right.
and nat gas is up at about $2.50. It's down today, but it's been on a tear. So basically, the differential has gone in favor of my idea by about 24% or so. So leverage 100 times, it's a 2,400% return.
When do you get out of a trade like that? How does Jeff Gundlach know when to exit a successful trade, either leveraged or unleveraged?
I'll tell you what, the biggest mistake that investors make when they're in a winning trade is they get out too soon. I think this trade has monster legs and will work another 25%. So basically what I look for is not so much exactly a price level, but for a market setup. The market setup was that the analysts were all kind of doing a pole vault contest on who could guess a higher high ultimately for Apple, and they were all doing the limbo on natural gas. How low can it go? And once I start to see that, I realize that the market's terribly offsides. Plus, Google in 2007 was believed the way Apple is believed today. And if you Google price projection 2007, this kind of sounds funny, Google, but you can see articles in 2007, everyone trying to outguess each other on where Google's going. It's going to take over the world, 100% market share, and the genius at Apple isn't there anymore.
Okay, I'll go with that just very, very quickly, and then we're going to come back with Jim Bianco. Is Facebook day one the new Apple?
I think Facebook is likely to do very well and be great subscription and go up a lot. It seems sort of emblematic of a market top, though, kind of like the tallest building thing that seems they always build the tallest. The Empire State Building was built in 1929, right? And now you've got the largest, the tallest building in New York again being built. These things, and the Facebook IPO,
they go in cycles.
It seems like the stars are aligning for a top.
Let's come back here. Jeff Gundlach with us. We're negative 88. The markets are really on a move. The 10-year yield has blown through the intraday low. We're going to come back. Jim Bianco with us, Bianco Research. We continue most of this hour with Jeff Gundlach of DoubleLine.